Hello and welcome to yet another instalment of our Nucleus Wealth Insight series. Just a quick reminder that the following presentation is general information only and does not take into account your personal circumstances. Whilst Nucleus Wealth aims to present informing and sometimes entertaining content, please consult your investment professional, financial advisor, or better yet, speak to us before making any decisions based on any of the themes discussed in today's presentation. And don't forget that this is a live presentation, so feel free to drop any questions you like in the chat box below and we can answer them along the way. If you're watching this after the event, make sure you attend the next one so you too can participate in the live Q&A section of our presentation. Our presenters today include myself, Tim Fuller, a certified financial advisor who has worked with hundreds of clients over the years, helping to make the complex simple for companies such as AMP, Mercer, and independent advisories. Sitting across from me, we have Nucleus Wealth's Head of Investments, Damien Klassen, whose 25 years in the world of finance has seen him as the founding partner and head of research at analyst firm Aegis Equities, head of quantitative strategy at Wilson HTM, and was responsible for mining, energy, and big data in the $60 billion global quantitative equity fund at Schroders, which are a multinational asset management company. And of course, for more information, please check out our people section at www.nucleuswealth.com. So hello and welcome to this week's instalment of Nucleus Investment Insights, and today we're going to be looking at stocks and bonds. So for those that tuned in last week, we did a deep dive into bonds and what they're all about, and this week I think through no fault of our own, but I guess the topic came up. We thought we'd talk about their relationship in a properly balanced portfolio and when to use stocks and when to use bonds and when to use both. So
and more importantly, what are you doing for this year?
Exactly right, and then looking into this year. So on that note, we'll jump into what we're looking at today. So we'll just do a quick run through of stocks versus bonds. We'll then look at a couple of cases. So times when you want to be looking bullishly or being pro stocks and maybe backing off on the bonds, or as they say, bull stocks and bear bonds. And we'll be looking at that on a global and also a local, from a global and local perspective. And then we're going to flip it around. So then we're going to look at times when you would like to be bullish or pro bonds or holding bonds over stocks as well. We'll then jump into some other cases, and then as always we'll bring that into line with our own investment implications and how we deal with these things and our projections going forward for 2019 in the portfolios we put together for Nucleus Wealth and the Macro Business Fund. So you may have heard him before, but I will formally welcome him. Good afternoon there, Damien, our Head of Investments.
Thanks, Tim.
And we'll jump into it. So stocks versus bonds. We've got a chart up here looking at the year to date and then also the 3-year performance of some various asset classes.
Yeah, so or year to December. So the calendar year for last year. So, I think the key thing for the stocks versus bonds argument in the long term is that stocks generally beat bonds in the long term. They're higher risk and you get a better performance from the higher growth assets whereas bonds you get a lower return. But you do get distinct periods where the opposite happens, and we've seen that over the last year and the last 3 years as well. So I've just lined up on screen and some of the key asset classes in Australia in dollars and how they've performed. So over the last year, at the top of the pops was Aussie bonds, and closely followed by world developed market shares and then cash. So sort of largely the themes we've been pushing for within our portfolio is this is where you want to be overweight. You want to be overweight Aussie bonds. When you're talking shares, you want world shares rather than Aussie shares, and then finally the and having a decent holding at cash.
Which is largely what's been happening for the last 12 months in our portfolios.
Yeah. Having said that, it was very much a tale of two halves. So the first half of the year, or first 3 quarters of the year, you very much saw that international shares were the dominant one, and then the last last quarter was where bonds really made a comeback, and we saw the shares sort of fall back to end up still in front of everything else. But it was very much a tale of, it wasn't a consistent sort of chipping away right throughout the year. so and then that's sort of reflected as well in the 3-year returns we've seen in the Aussie bonds, and that's been a matter of interest rates sort of staying lower than what most people expect, and that's where we think again for 2019. We don't think this story is finished yet, and we still think the RBA's got it wrong, and we still think the whole push, and we're starting to see more and more market economists come on board with our view, which was that the RBA isn't done with the rate cutting, and that the best they could have hoped for was that, keeping rates low for a long period of time, but they're probably going to need more support. And we're starting to see more and more economists come over to that view now.
Okay, all right, fantastic.
And we think that's going to flow through into bonds for 2019. The other thing to note, the Aussie shares, they're one of the worst performers. Having said that, if you look right at the bottom, then you go Aussie shares, emerging market shares were even worse. The developed market shares hedged in Aussie dollars is actually more of a reflection that a lot of the performance we saw in that developed market shares was Aussie dollar falling.
Yep.
And we spoke a lot about that being the hedge for Australian investors, was that on the positive side you saw when things are going well, international shares go up, and that's a little bit offset by a rising Australian dollar, but you had that falling Australian dollar to offset your losses if you in the more negative scenarios, and that very much worked out the way we're expecting.
Yep.
And there's still scope for that trade still. Having said that, it is a question now about do you want stocks? How much do you want in terms of stocks, and how much do you want in terms of bonds? We've sort of been, for the last year, we've been very much on the path that we wanted a little bit of stocks and lots of cash and bonds. And of the stocks we had, we wanted
foreign denominated.
Yep.
Okay.
Going forward into 2019, we're sort of been winding back our stock exposure.
International?
International. Our overall stock exposure, I guess, is one thing we're targeting. And then once we're into that, we're basically saying what we want is international. We're basically minimum weight Aussie. We've been minimum weight Aussie most of last year, and we're very much maintaining that. Our view is actually that that sort of chart showing that Australian shares, outperformed international developed markets hedged, was the wrong outcome from a quality perspective, because what we're seeing is Australian earnings were much worse than international earnings.
Sure.
And so what that's meant is now the Australian market's actually, if you go through sector by sector, is actually looking much more expensive on pretty much every sector versus the world.
Expensive.
Yeah, more expensive.
Okay. Yeah.
So sort of a worse outlook and more expensive. So yeah. Anyway, that's sort of the rough sort of overview of sort of what we're looking for stocks versus bonds. Having said that, though, there is a case for stocks to go up, and there's a and so we'll run into that first in terms of saying, well, where would we be getting it wrong?
Yep. Okay. Sure.
And what's the bull case for why you could see stocks sort of going up.
So we've got here, so we're going to look at the global side first. Now, we're obviously going to look at locally in a couple of moments, but the global one, so this is including Australia, is it, I guess, in a sense, the themes that we're talking about here?
Yeah, so the Australian market, from an international investor's perspective, is sort of thought about as a bit of a supercharged version of global growth. So if you're sitting in London or New York or Singapore and you're looking at your global stock allocation and you think global growth is going to be good, then you probably want some Australian shares, because they tend to go up a lot more. So you get a currency effect as well. So the currency goes up, the stocks goes up, and you sort of get double bang on the way up, and vice versa on the way down. So so you will see, even if local conditions in Australia are worse, you will see that if global stock markets boom, you'll probably see the Australian stock market do relatively well.
Yep.
Not as well as international, but and then the flip side is you can have cases where the Australian economy does much better than international, and it'll outperform the international, but it's more of we're going to get dragged along with what's happening internationally.
So we're essentially a bit of a coattail rider as an economy or as a stock market.
Yeah, and you'll oscillate around that, but it's very rare that you ever see that, say, a very strong global market and a very weak, a big negative Australian market, or vice versa.
Yeah, right. Okay. Yeah. So first line here, we've got the central banks reversing course and more QE as one of our bull cases.
So your best case for stocks is that central banks sort of
reverse
and print, and they throw lots more money at the solution, actually I should preface this by saying I'll go into these cases. I'm not saying this is an every single one of these has to happen, but it'll be some combination. You're unlikely to have every single positive event and every single negative, and the real the real push and pull between them will be how many of these come out in stocks' favour and how many come out in bonds' favour.
Yep.
But a reversal of central banks and more QE is going to be certainly very positive for stocks. It's probably actually a little bit positive not probably. It is a little bit positive for bonds as well. But there's probably there's a more negative scenario for bonds, is that the central banks don't reverse course, and they actually tighten the economy so much that you end up in recessions or big slowdowns.
Okay, sure. So
that's sort of your primary one. It's pretty hard to avoid Trump. So he's sort of in for the next. He's got a few in there that. Well, the two big ones for him at the moment is the imminent one is the US government shutdown, and whether that can be resolved quickly, and that could be resolved, in 5 minutes, I'm sure. But there's obviously a bit of a standoff happening there, and Trump doesn't like to back down, and so the question is where will it end up? I guess the big danger for me with that one on the negative side is that Trump seems to be quite attuned to what the stock market is doing. In terms of, if the stock market's falling, he's much more likely to. If the stock market's falling and it's seen as a government shutdown, then I think he's much more likely to come to
try and intervene,
a resolution. The issue for the last, say, month is basically while the government has been shut down, the stock market's actually been in its bounce off its sort of December lows, and so possibly from his perspective, his sort of correlation is not causation, but possibly he may believe differently.
Yeah. Okay.
And so I guess there is some sort of danger there that you see there. Then you go this quick resolution. So I guess the government shutdown resolved quickly is probably not such a major positive as more of an absence of a negative. The quick resolution to US and China and trade, again, I think that's not really a longer term. I think if there's a quick resolution, it's not going to be a lasting resolution. It's not going to be a long-term play. It's going to be a headline-grabbing quick win.
A couple of quick tweets.
Yeah, that's right.
On with the show.
Exactly. And so that's a short-term bull case. Maybe there's a bit of a pop. Maybe there isn't. Maybe there's a buy the rumor, sell the fact type thing.
Okay.
With that one. But I think there's that would be helpful, but the question is whether there are actually real underlying issues that need to be resolved there, and they're unlikely to be resolved quickly, and so it would be a short-term positive rather than a lasting one.
Yeah, sure. Brexit being further delayed.
Yeah, so there's certainly there's potential for markets to be there's certain potential for disruption, and so that, again, this is sort of like one of these. The absence of a negative rather than being a particular positive.
Yep.
But that's sort of
which can help though. With markets.
Yeah, absolutely.
Yep.
And then the big one for me. So the two big ones are the central banks reversing course. That's the major one. The other one is the fiscal stimulus in US and China. And so if you did see. And we spoke about this possibly happening, but given the acrimonious start to the Democrats versus Republicans sort of shutdown, it's seeming less likely. But we spoke about last year as one of the real bull cases being that China gets out and spends lots of money fiscally to support its economy with a trade war and a slowing economy, and it it feels the need to get out and throw more debt at the problem as again a short-term sugar fix, but not a long-term solution. And at the same time, you get some sort of deal in the US between the Democrats and the Republicans on infrastructure, which is something that's quite near and dear to the Democrats' heart. Is get out and actually a big fiscal stimulus that could be $1 trillion or more. That's looking less likely, but it's a pretty key positive in terms of that.
Okay, absolutely. Yeah, sure.
Actually, sorry, and we've got Brenton's. He's actually chipped in with exactly the same that same view. But I think on our chat. So feel free to toss in any questions.
Please do. Yeah.
So that's globally. Then when you look specifically at Australia, there's a few other issues that will very much drive Australia. And so if you wanted to see Australia sort of outperforming world markets, for us, the top one is that you need to see the housing market bottom and investor demand return. Maybe that's a government stimulus. Maybe there's a bunch of those other things come out and capital gets freed up in China and there's some sort of deal between their banks and you see all these international investors come back and you see the second step. Then again, there's Chinese stimulus to hold up commodity prices and possibly that you get a bit of a tax cut sort of boost from the election as to spur economic growth, but the top two are largely the key ones, and in our view they're sort of a little bit outside Australia's control. There's a bit in terms of the RBA cutting rates sooner rather than later, but
that's
to
not
help
a
the
bear
housing
bond
market.
case, though.
But that's not but there's that housing market is the key to us in terms of sort of seeing that if you can get some growth back into that. It's unlikely in our view, but that's this is your how if you wanted to get out there and
be buying
and go start underweight bonds and overweight stocks, this is you'd need to tick a large number of these boxes to sort of get there.
And so just the first one there, the housing market bottoming, obviously we're watching that unfold every day now.
Sorry, watching it unfold as a bottom or watching it fall?
Well, we're watching it fall, as opposed to finding the bottom. Sorry, that's right, hasn't quite ticked that box yet. But and you mentioned before, so government stimulus, potentially by way of first home buyer grants and those sort of things. Although we know that first home buyers make a very small, percentage of the market compared to the investors. And with the almost imminent Labor government, we won't call it just yet, but obviously that's the investor demand with a giant question mark over it if they push through their the negative gearing reforms.
It's pretty hard to I'll stress again. These are things you'd have to tick off a number of these boxes to get a bull case for stocks. But as you point out, to us it seems unlikely that any of these are going to reverse quickly. Having said that, maybe there is there are things that could happen.
Well, it's things to watch for, isn't it? That if it doesn't happen, then you've got yourself perhaps a reason to jump back in.
Okay, that's right.
Fantastic. All right, so let's flip it on its head now and jump over to the bull. Sorry, the title's a little bit. Well, anyway,
the bullish bonds case.
Bull bonds and bear stocks. So something that we feel is probably a little bit more likely. These following slides.
Yeah. So the key one is are central banks too hawkish and actually affecting demand, and it does seem very much the case.
So when you say hawkish, for those at home,
that means interest rate. They're either pushing interest rates too high in the case of the US. In the ECB, they're basically stopping or they're tapering off their purchases, whereas to us the European economy is still very weak and they probably need to up their purchases if they want to, and especially given sort of Brexit issues and popular sort of issues within both Italy and sort of popular sort of uprisings or unrest, I guess, in France, is that they've got issues over there that they haven't won the battle.
Okay, sure. Obviously, we mentioned before with China and the US trade continuing unresolved and unabated.
Yeah, so it's a tough one. This one, so I think the longer term view is that there are significant issues within the way China's conducting its trade policies. There's been a number of things in sort of Chinese chips and hacking and issues like that. I think China's got themselves in quite an interesting position where for most US companies, and to use Russia as an example, would never have considered to go out and buy all the computer equipment from Russia.
Okay.
For
a lot of reasons.
A lot of reasons, and one of them being, security and issues like that.
Yep.
And China's managed to get itself in a position where people have been comfortable to do that.
Yep.
And given though the pushback we're seeing, we think that's reversing, and that will reverse. And so so that's sort of one big issue in terms of that US-Chinese trade. And there are longer term issues that I think both sides are yet to come to close to an agreement on. And so our view is the short term. There might be a short-term deal, but it's basically a deal for Trump to, as he said, he wants a positive tweet. He wants to see if he can get the stock market to go up for a couple of days. That's sort of the best outcome. We think there's a long hard slog, and if there's a chance of a quick win, then China's not going to make major concessions, and
plus the longer it drags on, the better it sort of serves, I think, the US interests, in the sense that they can keep rolling out more and more bad press for the Chinese, IT sort of scandals and all these sort of things that are rolling out. You've got people getting apprehended in other countries and extradited, and trying to be extradited to the US. All this stuff just constantly plays in the US's favour, doesn't it?
I've just seen today, an Australian blogger detained, and so.
Where is David?
Yeah, that's right. David is on holidays, but he's assiduously avoiding to Chinese airports. There's
US government shutdown.
Yeah, look, that's another one. That does have. I think the estimates are sort of 0.1 to 0.2% effect on GDP per month, and so you've probably already knocked off 0.2% off the US GDP. The question is, if that sort of keeps dragging on, and Trump has sort of displayed a fair bit of intransigence in the past. Once he takes a position, rightly or wrongly, once he's decided this is the position, he doesn't like to back down, and so it's a little bit difficult. The more intransigence you see, it's difficult to see how he is going to back down, and what his position is going to be. So that could start making some real effects on the US economy.
Yep.
My take is, I suspect you will actually need the stock market in the US to take a little bit of a tumble to help him come to a realization that maybe.
Right.
A million workers not getting paid, and all the subcontractors and all that type of stuff not getting paid. Maybe that is a big deal.
Yeah, well, it certainly is to them, I'm sure.
Absolutely. Well, and to us as investment managers, absolutely it's a big deal.
Yep.
But there's it doesn't seem to be getting closer at the moment.
Yep.
But as I said, that could be solved in 5 minutes. So one tweet and we could be
back on the road.
Back on the road. Yes.
Hard Brexit. Yeah.
So.
Looking more likely now, given the...
Well, it's probably not. I mean, my guess would be, I guess it's actually looking more likely to be either a hard Brexit or some sort of go back to another referendum or stay in for extended or something like that. Probably looks more likely than the soft Brexit. And if that's the case, I suspect the odds are more likely that people will go to some sort of delay or re-referendum or whatever it is, but there's a major risk that sits out there, and I think there would be, we certainly saw when the referendum came out, there was a decent shock to the UK.
I remember that day.
Stock markets and world stock markets. I think the closer we get to and if hard Brexit starts looking more likely, then just the uncertainty, regardless of people's view about how much problem it's going to cause or not cause, we think it's a relatively big deal, but we also think that the stock markets will react negatively to it because it's a big unknown.
Well, that's right, and the whole purpose of a stock market is that you try and price in forward events, and if you don't know what the events are, you've got ambiguity in your pricing, haven't you? Okay.
Yeah.
Limited fiscal stimulus in the US and China.
Yeah, so this is the flip side of that other important one we said. So we sort of came up with a scenario where we could see both the US and China sort of, almost in a way they're sort of fighting a little bit of a trade war, but at the same time throwing out lots of fiscal stimulus to make sure there was not the fallout from the trade war wasn't particularly high. The issue in the US is, the government shut down now because of they can't agree on the budget, and so then to turn around after shutting the government down for 30 days because you thought that spending was too high, and to turn around and say, well, let's have $1 trillion worth of infrastructure spending now is not to say that Trump's not unwilling to take contradictory positions, but there's it obviously seems less likely than it did before.
Yep, fair enough.
China very much seems to be slowing.
So the final one is Chinese debt issues emerging. Sorry.
Yeah, and that's actually I'll throw that as a separate issue. So the Chinese fiscal stimulus is a major issue there in terms of they've tended in the past to certainly in the last couple of slowdowns to play around a lot with very small things. So they'll change a few rules and regulations. They'll try and encourage people to go out and borrow and spend more. They'll
meddle with currency.
Yeah, current bit of currency, reserve ratio. They'll do a little bit of interest rates. There's a whole bunch of little levers where they sort of play around, try and fix this issue, and then in the end they just it doesn't solve the issue, and so they throw the kitchen sink at it. So we sort of call it the kitchen sink stimulus, where they come out and another big load of debt and off it goes. The issue in China at the moment is they're already building a record number of houses in terms of record floor space is already under construction, and there's fewer people moving to the cities than what there was 4 or 5 years ago.
Yep.
So the reason for building the more houses has gone away. They're still building more. A lot of that is knocking down existing stuff and putting up new stuff, which is doable. You can keep doing that for a long time, but there's obviously an economic drag and slower economic growth in terms of that. As a long-term solution, there's not a long-term solution there. So they do need to transition away from knocking stuff down and building more of it to more service-based economy and more less capex and more consumption.
Yep.
Having said that, there's a lot of vested interests who all got very, very rich on this whole model of knocking stuff down and putting it back up again, and they don't want that to happen. And so there's been a push and a pull. Our expectation has been that there will be another big debt push, but maybe it won't happen.
Okay.
There is potential that.
What we're saying is eventually the carousel is going to grind to a halt. So if there's one or two more big positive sort of pushes in there, eventually it's just the lever's not going to work anymore when it's pulled, essentially.
But also there is a realization in China that this isn't sustainable and they need to transition away. The problem has been every time they've started to transition away, growth slowed so sharply that they've then jumped in and thrown the kitchen sink at it again. And so the question is, will this be the time when they finally go, okay, look, we've just got to bite the bullet. Better that we do it now and get it over and done with and take the economic pain early rather than try and delay it as long as possible and have a bigger problem in a few years' time.
Yeah, right, okay.
And so maybe they'll actually go down that path. It's hard to tell.
And it's sort of interesting because governments aren't often known for taking economic pain if they can help it, generally because they need to be re-elected at some point, where China's sort of not really, in that realm of democracy.
Yeah, so. More importantly, Xi's now emperor for life.
Yeah, so, that's it.
Yeah, but on the flip side, emperor for life is positive in terms of saying, yes, you can make longer term views and you can actually take the pain and things like that. The flip side is when you're the man in charge of everything, you get the blame for when things go wrong as well.
100% of the time.
And that seems to be certainly emerging over the last year or so in China, is that Xi is getting the blame for a lot of these issues. And so the question will come down to saying, well, he still has to, if you're emperor for life, you still need to keep your next tier relatively happy. And so the question is, will he sort of succumb to vested interests demands to get out and spend more money and throw more debt at the problem?
Okay.
So then the final one, the Chinese debt issues emerged, is there are significant. China's sort of never had as much debt. It's got the level of debts, the amount of debt they have to throw at getting another GDP point of growth has never been higher. So you only needed a little bit of debt to generate all this extra growth, whereas now they've reached a debt level where they've got to throw lots of debt to get not very much growth. And so there is, potentially they call it a Minsky moment where people suddenly realise this isn't sustainable. I mean, everyone knows it's not sustainable, but everyone looks and goes, yeah, it's not sustainable, but it is sustainable for a bit longer.
Mm-hmm.
And maybe they hit the stage where, all of a sudden there is that, flip side where it just goes, no, it's not sustainable now, and this is the point when it all turns down, and you do get some sort of debt crisis. It's probably the least likely of those, but it is the biggest. It's probably got the biggest effect if that actually
does actually happen.
If you have a debt crisis in China, then all bets are off for then now you're looking, definitely bonds are going to outperform stocks, and stocks are going to get smashed in terms of the whole, that's your biggest negative risk.
Okay, yeah, sure.
So that list there is there's some that are more likely and some that are less likely. Having said that, some of the less likely ones have got pretty dire negative effects. So you need to sort of weigh them up in terms of, and when you're putting your case together.
Okay, all right, sure. So we'll jump across now to Australia.
Getting the headings wrong on that one should be the other end.
Bullish bonds and bearish stocks for those following along in the webinar.
Yep. Okay, so your issue here is your falling housing market continues to weigh on your growth, and possibly you end up with start getting some debt issues in terms of the banks.
I was already worried about that now, isn't there?
Oh, absolutely.
Yeah.
And so look, that looks like the current path, like the glide path looks like that's what it is. And the question now is, do you get some intervention? And so the RBA, could help certainly with some rate cuts. They'd certainly probably put a little bit of a floor on it for a bit. Having said that, if they wait too long, and they get that snowball effect of, and possibly they've already waited too long, who knows? You get that whole snowball effect, and goes from people go from, I've got to buy a house at any price before I miss out, and I'll never be able to buy a house, for the whole of my life, to wow, housing prices are falling really fast. I'm just going to step out of the way and wait to see where it finishes up.
Yeah. So well, obviously the inverse, where if you try and buy in a month's time, you're paying more. Where now you're just getting a discount for holding off and being happy in your rental position. Yeah. Obviously, there I'll throw in, because I can't say there, but the Royal Commission might have a part to play in some of these debt issues as well. Probably less about prior or current debt issues, but more about the way that things can be set up going forward. So lending standards.
Absolutely. I mean, I'd sort of put that pretty much the fall in the housing market so far on right back on the Royal Commission actually, giving us proper standards of
instigating guesses.
Yeah, I mean, in the end, it's saying, if if a lot of your boom was driven by lending to people who shouldn't have been lent to, then when you stop lending to those people, that's what causes the house prices to come off.
Absolutely.
There are other factors at play in the Australian housing market that haven't yet, been seen, and they can also make housing prices fall further. So the excess supply is still coming on over the next little while, and then you can start having you can very easily see we're starting to see issues with approvals coming out. So the actual supply will start to dry up, and then you start seeing job losses, and that's quite the housing market's a sector which is very much inbuilt into the Australian economy in terms of the multiplier effect of all the people who get paid from state governments through stamp duties to lawyers and property trusts, real estate agents, and you go through all your tradesmen, and there's very much a multiplier effect there. So that will go into reverse. So certainly issues there.
And so, when you relate that back to the bull case for a bond, is that that more on the bearish stock side as opposed to a bullish bond play? Or?
Nope. That's the bullish bond play. There is the Australian long-term interest rates are sort of 2.5% to 3% ish at the moment, and we're sort of top of the world, so to speak, top of the developed world in terms of where they are. So even though they're very low. European rates are close to zero. US stock rates are they're roughly the same as ours, but they did get very low. Somewhere like Canada, which is a very similar economy to the Australian economy, they bottomed out. Some of these long-term bond rates bottomed out at sort of 1%-ish. So Australia's managed to get through the sort of the post of the
GFC,
financial crisis, based on having a close relationship with China, which was growing very strongly, and that meant that interest rates stayed higher in Australia than what we saw overseas. If you start getting some serious Australian weakness, and this is, it's our expectation this will happen. The question, it's more of a question of timing rather than, will it happen? In our mind, is that you will see Australian bond rates go lower in that scenario.
Yep.
And if some of these world events happen at the same time, then we're headed back down to similar levels you would see from a lot of these other countries around the world.
Okay, sure. You touched on their growth problems in China. So
if you do get those growth problems in China, then commodity prices will fall, and that puts a dent in Australian companies and capex and plus tax receipts as well. So that's another negative over and above. So I spoke about Australia being a sort of turbocharged growth on the world.
Yep.
And so if you see some of those world growth issues affecting China, that's going to affect Australia way more than what it's going to affect, say, stocks in the UK or stocks in the US.
A little more diversified and less attached to one economy.
Yes.
The dragon's back, as
that's
it were.
Right. Yeah.
Okay, sure. Companies delaying capex due to elections. This is an interesting one.
Yeah, so we've had three elections over a short period of time. One's down. The Victorian one's in. There's New South Wales, so the two most populous states, and then we've got the federal election coming up. It often makes sense for companies around these times just to put back, if you're going to spend $100 million on some new factory or something here or something there, often makes sense to just delay it a couple of months. You're spending a lot of money, and just wait and see what will the new regulations be. Will we have negative gear, and won't we have negative gear, and what are the various inputs that will go into it? And so you frequently see that, and so we've had one election away. We've got another two coming up over the next few months. It's highly likely in our view that companies will delay capex, and that sort of puts a bit of a hole in economic
data
terms.
Sure.
A lot of it will eventually come on, but if there's a hole in that, and then eventually, and at the same time housing prices are falling, and you start getting that snowball effect, then that can push you.
So in the current climate, you might spend 100 million, and then post election you might just spend 50 because things have changed. And okay, very good. RBA reverses course too late. Well, the RBA is not known for its actions, particularly recently.
Well, look, we already spoke about this one being no meeting in Jan, so they've sort of it's been a while since their last one. They probably need a few months to sort of
get the feet back under the desk.
Well,
dry the towels.
They tend to like to telegraph a bit to the market, and change the word. I think the wording you've seen a few of their sort of chosen media mouthpieces starting to talk more about maybe rates won't rise now, and maybe there's a slight chance that events could happen that could make them fall, and that needs to turn into a more firmer, maybe they could fall to look, if this keeps happening, then they will go down. So the question there is, if the snowball gets too big before they do that, then that's that might be out of their control by the time they have cut rates. Housing market's already in free fall, and people are just, as you said, standing back. Well, I'll wait to see where it hits, and I'll pick the pieces up afterwards.
Okay. Tips on RBA this year? If we're looking into 2019, we've certainly got one cut baked in. I won't get you to pick a month or anything, but there's a jaw boning, as you say. So
look, I mean, coming back to some of these cases, if you see that some of those global growth cases pick up and China does start spending, then you might there might be maybe one cut, one or two.
Yep.
I think if some of those more negative scenarios happen globally, then you're definitely seeing two cuts, and you're probably seeing quantitative easing or something at whether it's this year, at least towards the end of the year and into next year, you're seeing some pretty dire scenarios, I think, for the Australian markets.
Yep. Okay. All right. So thanks for that.
And the last one, that overpriced stock market, I spoke about, the Australian stock market return. So at the moment, we're at about a 10% premium to world markets.
Wow.
So, and as I said, you go through sector by sector. Australia should generally be at a discount, because the two biggest sectors in Australia of banks and resources trade on lower valuations than other stocks in the world.
Okay.
So if you go up and line up sector by sector and say,
global banks versus local banks sort of thing.
And global property versus local property, and go one by one through the sectors, then it's pretty scary how much more expensive the Australian market is than overseas competitors.
Wow, okay.
So, at that point, you're sort of going, well, just from a purely valuation perspective and growth outlook, it doesn't look like the time
to be buying.
To be
in. Okay, all right, fair enough. All right, so that wraps up our case number 2. So we'll jump across into investment implications and how we work through money every day at Nucleus Wealth.
Yeah, so basically what we'll do, so the idea for us for investment for this year is that we're very much looking at this as so we've treated this as a ride the Trump boom, but don't try and pretend that this thing's going to last forever.
Okay.
And so as we sort of got into movements sort of late last year, we were winding back our stock exposures, and then the market sort of took a tumble. We sort of topped up a little bit on some of the falls, and as we've seen the rising now, we've sort of let that, what we topped up on, we've sort of been letting that go.
Okay.
And so we're sort of looking very much on the defensive side. We think being defensive is key in your portfolio for this year, knowing when, we think there's a decent chance bonds will outperform again.
Mm-hmm.
And so we're quite overweight bonds. We are very much underweight Aussie equities, so sort of minimum weights effectively in pretty much every portfolio. So if we can hold less Aussie equities, we will.
Plus, our investors have the ability to remove all Aussie equities,
themselves
if they wish themselves, and then just switch it back on later on. Yep.
Yeah, and then so in terms of equities is very much trying playing that risk overall. So we've been underweight equities for a while, but overweight international within that space.
Okay.
And we're sort of playing that similarly, but now it's just a question about, as markets rise more, where we're winding back. There is a possibility that some of these positives all come out all at once, and we see a bit of a spurt. I think you could certainly see, if there's a quick resolution to some trade and the US shutdown.
Yep.
You could see another, a bit of a spurt on the markets and add some performance quite quickly.
Okay.
We'd be using that to pull back even further.
Right. Okay. So that takes them off the table. Okay. Very good.
So very cautious overall, and we thought we'd go into a bit of we'll go put a bit deeper into some of the bear scenarios next week in our
in our upcoming next one, but let's stay tuned for that one. Okay. Well, on that note, we'll hear some more about Nucleus Wealth. Nucleus Wealth and the Macro Business Fund was put together to help give you access to quality, well-researched stock analysis and superior macroeconomically minded asset allocation. We use technology to help us provide a service typically only available to high net worth and sophisticated investors at a fee level that rivals the more basic solutions available to everyday investors. We do this by using separately managed accounts, which allows clients to enjoy unparalleled transparency of what they own and why. It also means that each client effectively owns their own separate and discrete share portfolio managed daily by us. We have partnered with Linear Asset Management, who are backed by the ANZ Bank for Cash Management and JP Morgan, one of the biggest banks in the world, as custodian of your assets. In our new personal superannuation option, we have partnered with Praemium, who is backed by HSBC as custodian and ANZ for cash management. We feel these structures are the gold standard for your financial protection. In addition to this, we offer 19 separate and individual ethical screens that you can use to help tailor your investment, to ensure that your money is not being used to support companies that deal in areas and practices that you feel are important. By eliminating only the areas that are important to you, you avoid missing out on the potentially higher returning areas that you are ambivalent about, which are often ruled out in other broader ethical investment options currently available in the market. The name Nucleus comes from our ability to provide the core holdings of a client's portfolio, allowing them the time to explore areas that may be of interest or they have experience in. We also offer a complete investment solution for those who don't have the time to coordinate their own investments. Our investment team has decades of experience in world markets, and we have access to a global team of stock analysts. By removing the layers of middlemen that sit between your money and the markets, we've been able to reduce fees and provide unparalleled transparency in the solution we provide. For more information on what we can do for you, please call 1300 623 863 or contact us through www.nucleuswealth.com. And for those who haven't tuned in over the last month or so, well done on a great holiday period. And I'll just let you know that our personal superannuation is up and running, has been since late last year. Feel free to head over to portal.nucleuswealth.com if you're interested in investing your personal superannuation on top of everything else you can do with us. You can jump over to that site to select your ethics, compare your fees from the top 40 or so largest super funds in the country as well. And you can also have a look at the advice. So we're happy we can provide you investment advice internally on the online portal, and we can also help you seek a face-to-face advisor if the need permits. Next week, we've got a terrific topic with our resident bear, Dave, coming back. I shouldn't say that, actually. He calls himself more of a realist. But so we've decided to call this one Who Woke the Bear? So we're going to be putting together the bear case for the Aussie and world economy in the next year, and looking forward from there. So same bat time, same bat channel, 31st of January on Thursday, 12:30 Australian Eastern Standard Time. And to check that out, head over to the Nucleus Wealth live webinar page. Can't wait for that one. It'd be great to have Dave back on the panel. So as always, thanks very much for watching. I hope you got something out of it. I certainly did. As always, we are available on Spotify, Podcast Addict and iTunes if you'd like to hear this rather than watch it. And if you could, please head over and give us a review or 5 stars or a like, or some way to show your appreciation, and it just helps drive our message out there and get in front of more people. So on that note, thanks very much for attending, and look forward to catching you at the next one. Cheers.